Good afternoon, everybody, and thanks so much for joining us for today's webinar. My name is Marianne Hensley, and I'm the Vice President of Sponsored Content Operations here at FreightWaves, and I am thrilled to be here with Craig Fuller, our CEO and Managing Director, and Ibrahiim Bayaan, who is our Chief Economist, to share the latest factors affecting the freight markets today. If you have any questions that you need to reach out to our team for, you can do that through the chat function in your Zoom control panel. And don't forget to submit your questions for Craig and Ibrahiim during the Q&A. You can submit those throughout the presentation, and we'll get to those at the conclusion of the presentation. At this point, I'll go ahead and turn it over to Craig and Ibrahiim.
So Ibrahiim, good to see you again today.
Yeah, it's always great to come on.
It's fun. You know, we were just talking before that we're almost have done this for a full year now.
Yeah, exactly. This is actually our 12th webinar that we've given.
So we've rounded out the year. It's interesting if we look back to where we were when we first did this, and you and I didn't know, you'd been here a few months. I didn't know you that well, but now I've gotten to know you pretty well. It's interesting how much the market has changed in that period of time.
No, absolutely. Like, you think about when we started, it was pretty much like the peak time of last year for the trucking industry. And it's significantly more subdued this time around.
Yeah. So we're going to talk about that. I'd love to know if you are a bear or a bull. I went from a bull when we first started to becoming pretty bearish, and we'll see.
Yeah, I'm in a little bit of a holding pattern. And we'll talk about why that is soon.
For an economist, is that a bear? Would that be certainly more bearish than you were 3 months ago?
Surely.
So, well, this is Craig. I'm, as Marianne kind introduction, the CEO and founder of FreightWaves, and Ibrahiim is our chief economist, who's been in the industry for the past couple decades. Ish. So a little bit about FreightWaves for those that may have recently come across the business is that we're building a community that tracks data and provides context to the market so that industry participants can analyze, react, forecast, and then ultimately de-risk their positions in the market. Our team is made up of over actually 25 reporters, and that's expanding. We think by the end of the year, it'll be around 40, and we actually have a number of economists on the team, along with some PhD data scientists. So I believe you're a PhD, are you not?
Yes.
So people sort of know to listen to you. And then, of course, we provide our information informed by both data and what we call here at FreightWaves tribal knowledge. In other words, experience. Being in the industry, having the experience of what this stuff means can make it actionable for those that are a part of it. And of course, we want to thank our friends at Convoy for their ongoing support and continuous development as we provide insights into the freight market.
So just to take a quick look at what we plan on covering today, I'm going to start with talking about the first quarter GDP and what to expect when the second quarter numbers come in next month. And talk a little bit about recent freight demand performance and where the state of freight demand is as we end the second quarter. And then I'm going to dig in a little bit into some of the policy changes that have happened over the past month. I mean, it's been a busy 30 days, really, since the last time we got together, just on the policy front. So we'll talk about some of that and what that means for the outlook, looking at and then switch gears, look at trends in freight capacity and pricing, and then finish off talking about the freight market itself and some of the regional freight patterns that we're seeing in the data. So just as a general summary, I think when you look at freight demand, to categorize it, I would best say that it's just kind of stalling. It's been pretty flat since the start of this year. On the manufacturing and international trade side, both of those are struggling. They're down since the beginning of 2019. Retail has stabilized a bit, and I think that's helping to keep the overall freight fairly flat. Hiring, which had a great year in 2018, is now stalled within the trucking industry. It's been flat over the past several months, and trucking rates have been coming down fairly steadily.
So really my summary is if we look at June, we did see increase in volume. And actually, I would say some early signs of encouragement compared to May. Seasonal volumes did return to June. I think the question that everybody's asking, and I don't even know if there's a consensus here yet on whether the June surge or the June volume increases have been strictly seasonal, or are we seeing some signs of firming in the market? We'll talk a little bit about that. We have a theory on that. And then, of course, activity around the ports remains stronger than average. It was interesting because over the last 7 months, we saw significant activity driven by port activity. May, actually, we saw a shorting of volume around the ports. And then in June, we've seen some increases come back. And then, of course, refrigerated demand has actually been pretty hot this year. I don't know if that's there's been a lot of demand for refrigerated capacity, and even flatbeds showed some sign of life in June, which we have not seen really the flatbed market show up most of this year.
Yep. So just to get started on the current economic situation, this here's U.S. gross domestic product, right? And the blue bars here are the quarter-over-quarter growth rates. The black line is year-over-year growth. So a couple things to note here. GDP underwent its last revision for the first quarter this morning, and it was unchanged. It still showed 3.1% growth quarter-over-quarter and 3.2% growth year-over-year. That's very strong year-over-year growth for the overall economy. Now, I mean, the last time we got together, I spent a good amount of time just talking about the reasons why I don't think GDP is necessarily the best metric for analyzing freight performance. There's a lot of things that are counted as part of GDP that don't necessarily tie to freight movements in the economy. And there are also things that help drive freight activity, such as imports, that don't get counted in U.S. GDP. And so I talked to you last time, and I said, there's really a better way to look at this kind of data. And so I think going forward, we're going to start to disentangle some of these GDP numbers and give it to you in a more digestible form that's more relative to freight. And so here I have basically it's private final goods demand in the economy. So this is the goods economy, the state of the goods economy in the U.S. And essentially what that is it takes the GDP components, it strips out the services, it leaves in the imports, and then looks at goods movements throughout the economy. And the thing that you notice here, this is year-over-year growth here, is that instead of having like the 3.2% growth that's really strong in the first quarter, you actually see a decelerating pattern in freight demand. Really like the peak periods for freight demand year-over-year were the beginning in the fourth quarter of 2017, right? You're talking about 5% growth year-over-year, and it kind of stayed around this 4.5% to 5% growth rate through the first half of 2018, through the third quarter of 2018, and since then it's been decelerating. Now I'm expecting, based on the numbers that we're seeing now, like I think for the second quarter it should be basically less than 1% growth year-over-year. Okay, and so just keep in mind that like when you take a closer look at some of the things that directly tie to freight activity within GDP, it shows a significantly worse picture than what, say, the headline GDP numbers were to look at. And this is year-over-year growth. If you actually look at like the quarter-over-quarter growth or the levels, this final goods demand has been basically flat since the start of the year. Like
So growing up in the industry, one of the things I always heard was if you see 2% GDP growth, then that is a bullish. Anything above 2% is bullish for the freight market. And it seems like as you look at this revised sort of analysis of the market, that anything below that 2% on this particular index, which is private final goods demand, could be really the more reliable barometer of freight.
Right, exactly. Like I think a couple of things to take from this is that, one, last year when the GDP growth was about 2.5%, keep in mind that the freight economy was basically growing twice as fast as that, right? I mean, it was growing about over 5%, a very, very rapid growth. And now that like the overall economy is starting to show some signs of slowing down, like it's being felt first on the freight side of things. And so again, I think, this will be in Sonar pretty soon. We're in the process of getting...
This is that index that we talked about?
Yeah.
I love it. I love it.
I mean, I told you, there's a better way to kind of look at this data. The challenge that you have is that people they'll see the disconnect between GDP and freight, and they'll throw the whole bucket of GDP data away, say it's not useful. Reality is you just have to focus on the things that are important.
Now this is non-government spending as well.
So this is right. It's all private activity. So
when they build a highway or something, that is not shown up.
No. Okay. You have to look at it. I mean, there's components that'll show you that, but it's just not in this number.
And those tend to be long-term contracts anyway.
So digging into some of the components of freight demand, this is manufacturing and industrial output. The white line here is total industrial production. Blue line is manufacturing industrial production, which basically strips out like utilities and mining from the total, right? And a couple things to note is that manufacturing activity has slowed down considerably over the past several months. This isn't a new trend. I mean, it's really been going on since the fourth quarter of last year. Manufacturing actually briefly went into negative territory in April, and then it bounced back a little bit in May. But even the bounce back in May was primarily just driven by autos. Like if you took autos out of the manufacturing activity in May, manufacturing was basically flat there also. And so the manufacturing sector still has significant headwinds that it's up against. For one, business demand isn't as strong as it was in the middle part of last year. The export environment is poor, and there's a lot of uncertainty around industrial output and manufacturing. And I think it ties to tariffs. So just to dig into that a little bit further, this is factory orders. So these are the orders that manufacturers are receiving in the economy. The white line here is durable goods, stripping out transportation. And the reason why we strip out transportation is because there's always these volatile swings in airline orders that make the numbers look exaggerated in one direction or another. So we just strip out the transportation to get a cleaner picture of what the trends are doing. And then the orange line here is non-durable goods, which are the things that are designed to last for less than 3 years. So durable goods are things that are longer term. Non-durable goods are things that you typically replace within 3 years. But the thing to note here is that really over the past several months, really beginning in the third quarter of last year, orders for both durable and non-durable goods have essentially stalled. Okay. Now there's a lot of factors at play here, but I wanted to call attention that really from that moment in July when we began implementing these tariffs on goods coming in from China, right, we've kind of seen business demand stall out. And that's led to just a flatlining of orders in the economy. Now it's not a desperate situation. Like I mean, in this chart, you can go back to say what durable goods orders and non-durable goods orders were doing in 2015 and 2016 during the last freight recession, and you can see they basically cratered during that time. So we haven't gotten to that point where you're just seeing outright declines in orders, but you're just seeing a stalling out in the number of orders that manufacturers are receiving, and this is translating into this manufacturing sector that really isn't showing much growth at all during the first part of this year. Shifting gears and taking a look at just labor market conditions in retail. A couple things to note about the labor market. One is that May's job growth numbers were pretty disappointing. It was only 77,000 jobs added in May. There's kind of a couple ways to view what might be going on in the labor market. One is to say, well, it's just a temporary thing. I mean, the job numbers, they have these 1 month poor readings from time to time. And so we'll kind of be watching in the next couple of weeks to see whether or not you still get weak job numbers coming out. But there's a decent amount of reason to believe that maybe like tariff uncertainty is playing a role in hiring also, that if businesses are also not spending as much on investment and not ordering as much for investment goods, maybe they'll begin slowing down the pace of hiring also, and you start to see a stalling out there. Now, this is important because it's labor market conditions that form the foundation for retail. Like as long as you have strong job growth and you have strong wage growth, this will translate into strong retail activity. So we'll be watching to see what's going on there. The labor market is still very tight. I mean, by any historical measure, we're in very tight labor market conditions. There aren't a lot of available workers out there. In fact, there are more job openings now in the economy than there are unemployed people to fill them. And so you're still in this very tight labor market environment, but just watching to see whether or not there'll be any signs of softening going forward. On the retail side, retail activities held up fairly well over the past couple of months. There was a bit of a concern in the early part of the year. We had a couple bad months in December and then followed up by another bad month in February, leading some people to think that, maybe that part of the economy was also starting to slow down. But we've had better growth in retail over the past couple of months. And retail year over year is kind of stabilized in this 3% range, like between 3 and 3.5%. Now, that's not as fast as what we saw last year, where we saw growth consistently over 6% in the middle part of the year. But it's good news that it's not trending downward towards negative territory. It's kind of stabilized in this range. But again, a lot of this hinges on labor market conditions. And I think as long as the labor market holds up, retail activity will hold up, and that's going to kind of keep freight demand overall pretty stable.
I think this is probably, if you have a sort of thought of the rest of 2019, that it becomes a retail story if you go into fourth quarter. I mean, third quarter is typically smaller. At least September is better, it picks up. But, that July, August is always sort of soft retail. But if we look at the fourth quarter and going into the remainder of the year, as long as retail holds up, then that is a more bullish sign for the freight market.
Sure. And again, as long as you have good job growth, good income growth, I think retail will be fine. Like the confidence numbers have come down a little bit. They're still elevated relative to what we would have seen like a couple of years ago. So I think consumers still generally feel pretty good about the state of the economy.
The things that sort of drive that summer surge are typically related to like produce and agricultural products and construction, which are not don't show up in the fourth quarter numbers typically.
Yep. And within retail, just pointing out the strength of e-commerce. I mean, this you can kind of show this chart at any point, and you'll usually find double-digit growth. This is electronic shopping and mail order sales, which isn't purely e-commerce. There's other stuff in there. So, for example, like catalog sales, that's in here, and then like if you ever order anything off of, say, an infomercial through the phone, that also falls underneath this. And so this actually grows a little bit slower than what pure e-commerce grows. And but it's a monthly indicator. It's a good timely indicator of how e-commerce is doing. And the one thing to point out here is just it's consistently strong. I mean, e-commerce is one of the more resilient areas of the economy that even in in weaker times in the economy, e-commerce still manages to grow around double digits. I don't think this trend is going to slow down in any meaningful way anytime soon. That's really good news if you're in the small package side of things, or if you're on the LTL side, you get a bit of a benefit from all the e-commerce that's going on, especially on the LTL side, because e-commerce gets broader as it grows and it starts to include bigger and bigger things that don't necessarily fit on a package truck.
Now, I got a question on e-commerce data specifically, and I don't know if you know the answer question. When somebody orders something from like DoorDash, the food delivery services,
mm-hmm.
Do they show up the e-commerce number? Are they assessed through that, or is it?
So that's probably going to fall under food service. It's definitely not going to fall under this number here, but it's going to fall under a food service.
Got it.
Basically.
So even growth happened in the on-demand stuff would not show up. So
not necessarily.
It maybe a bigger story in freight related than even this chart shows.
Yep. And so taking a quick look at housing activity, this is new housing sales. Housing's been a pretty consistent area of weakness over the past several quarters. Like even last year, when most of the other areas of freight were doing very well, housing wasn't doing that well. Now, there's sort of constraints on both sides, both on the demand side and on the supply side of housing. On the supply side, like trucking, construction companies are having a hard time finding qualified workers. And so, sometimes they may want to build, but they just can't find the people to help build these houses. They also have a shortage of just like developed lots to build on, which is restraining the supply. That in turn has put some upward pressure on prices, although that's been easing up a bit over the past couple of months. Which is making it harder for buyers to buy. Now, I think going forward, I do expect some improvement in housing activity, but I think it's going to be subdued just in general. People got pretty excited in the fourth quarter of 2017, first quarter of 2018, because there was a meaningful amount of housing activity going on in the economy. But now that looks more just like temporary rebuilding after the hurricanes in the third quarter of 2017. And I think any improvement that you see on the housing side is probably going to be fairly muted as you go forward. On the trade side, also some pretty poor news, both on the import side and on the export side. You see just downward trends in import and export growth. Both exports and import growth turned negative year over year in April. Some of the preliminary data from May says that there was some improvement there. There were preliminary numbers that came out yesterday, a couple days ago. Basically, it saw like a pretty strong rebound in both imports and exports. But I think most of that is just like tariff fluctuations. There were tariffs that were, when the U.S. decided they wanted to increase the tariffs on China, those are set to take place in June. I mean, they began June 1st. And so I think there was a bit of a rush to try and get things in and out of the country before that happened. But I think this downward trend in trade is likely going to continue as long as you have this kind of tariff uncertainty that's hanging over things. It's probably going to push this growth negative year over year as we go forward. Similar results coming from survey data. This is Institute of Supply Management data, which is basically a survey of purchasing managers asking whether or not particular activity is expanding or contracting. Here I have manufacturing new export orders and manufacturing imports, which is the orange line here. And in both cases, you're looking at readings that are right around that expansionary threshold of 50. So on the import side, it's actually below 50, saying that activity is contracting. The export side, it dipped below 50. It's slightly above 50 now, but in either case, not good activity on the international trade side. So just a quick policy update where we stand on things. It was very interesting that we had our last webinar about a day before the U.S. had that scare with Mexico, the trade policy where we announced escalating tariffs on Mexico. So a lot's kind of happened over the past 30 days on the policy front. With the U.S. and China, the U.S. has already ramped up tariffs on $200 billion worth of Chinese imports to 25%, and off and on threatening to either increase those tariffs even further or broaden the range of goods that are subject to these tariffs. I would say that there's a scheduled meeting between President Trump and President Xi scheduled for, during the G20 summit, which begins tomorrow. And so we'll be kind of watching to see whether or not there are any positive developments. I know some of the more recent signs have been more positive, suggesting that there might be room for some negotiations. I don't expect any kind of comprehensive trade deal to come out of this meeting over the weekend, but any kind of positive news on that front I think would be helpful. Earlier I talked about how like this stalling out in the manufacturing sector really began when we started implementing tariffs on China. I think as long as you have this kind of uncertainty hanging over, it probably continues to stall out. So any kind of clarity in one way or another, I think would be helpful for manufacturing activity and freight demand. On the Mexico front, President Trump threatened some escalating tariffs on Mexico and then sort of backed away from it as we got to the deadline. So we never really implemented any tariffs on Mexico. I would say that there's a chance that the damage has already been done there, though. Right after the President Trump announced this policy, I wrote an article on FreightWaves.com where basically I said the unique thing about these tariffs on Mexico is that it's not it was tariffs being used to address a non-trade related problem, right? That we've kind of reached the point where tariffs become this general weapon to be used to address any kind of international conflict. That if you have a problem with immigration, we can use tariffs. If you have any kind of dispute with another nation, then potentially tariffs could be sort of used as a general weapon to address those kind of issues. This is an interesting kind of environment to be in from a business investment standpoint. I mean, if you think about like what a firm does when it's trying to decide where they want to locate their factories, it becomes difficult to decide where in the world you can put your factories if at any time, if there's any kind of dispute between the U.S. and that country, there might be tariffs that come to play. In fact, a lot of companies that were already in the process of relocating their factories from China or thinking about plans to relocate from China to avoid tariffs, they were thinking about moving them to Mexico to set up operations. And sort of in the middle of setting up these plans to move operations to Mexico, you get new tariffs on, that are being announced that potentially could happen in Mexico. So I think it's just an interesting kind of environment that we're in now, where it feels like tariffs can kind of be used at any time to address any sort of thing. And then on the monetary policy front, the Federal Reserve held their rates constant at the last meeting, which was earlier in June. They've kind of been slowly inching towards having a rate cut. Like every time they meet, they seem more and more likely to have an interest rate cut. I think an interest rate cut is fairly likely before the end of this year. In fact, it could happen as early as the next meeting that they have in a few weeks. I would say that this is an interest rate cut would be positive overall for growth. It helps consumer spending. It also helps business investment spending. The effects that you get from an interest rate cut probably don't come until next year, though. So even if they decide at the next meeting that they want to begin cutting interest rates, I don't think you feel any kind of positive effect until you get to like the beginning parts of 2020. I don't think it's necessarily a 2019 story. So on the demand side, just to quickly summarize, when you look at demand, manufacturing's not doing well. In fact, it's basically stalled. Trade does not look good either. It's likely going to trend negative. Housing also doesn't look well, and retail's kind of keeping things flat because it looks pretty positive. And so I would describe the demand environment as being pretty flat overall. On the supply side, normally when I talk about capacity within trucking, I like to focus on trucking hires and the amount of employment that goes on. You can see the surge in trucking hires that took place through most of 2018, where we added about 45,000 jobs in the industry. That's since stalled out, like really since the beginning of 2019. You haven't seen any net new additions to trucking employment in the economy. I think that's in response to the fact that demand's just kind of died down. And I don't expect any more positive, significant upward movements in trucking hires going forward. In fact, I think it's probably more likely that you see trucking employment go down before you see it go up in any meaningful way, trend speaking wise. And so you have this environment where like capacity expanded through most of 2018 and demand has died down in 2019. And all that means is that it puts downward pressure on rates. And so here's producer price index data. The white line here is just general freight trucking. So this is trucking rates overall, all the different kind of modes within trucking. That's come down. The blue line here is just long distance truckload rates. And you can see that growth there has died down quite a bit faster. It's now about 2.5% year over year. 2.5% year over year historically is about average. I think there's probably still room to go down further. Even if you see freight volumes improve some in upcoming months, I think the fact that capacity expanded as much as it did in 2018, and you have all this additional capacity at the start of 2019, is going to keep downward pressure on rates, even if you find improved volumes. And just similar data to reinforce that this is survey data that we get from the Logistics Managers Index. This is very similar to like the ISM Index, where they're asking logistics managers about different aspects of activity. This is transportation prices, and that dipped below the expansionary threshold of 50 for the first time in the history of the index, right in the May data. So just to reinforce this idea that I think rates are coming down, even if volume improves a bit going forward, I think there's going to be downward pressure on rates.
It's really the word contract or committed rates is where you see the downward pressure.
Yes.
Spots correspond to market conditions.
Exactly. And not only that, spot rates are, they're already down.
They're low, right? As we'll talk about in a second. But the real contraction in price is really related to that quote unquote contract rate.
Right.
So, and speaking of, we're going to dive into the freight market update and go into what we're actually seeing in terms of freight information. Our data is derived actually from IoT devices, TMS systems, as well as ELD devices and other data sources. So we actually get electronic data, and most of the data is within 24 hours. And so this is really reflective of the general market conditions. And there's actually a lot of the data is weighted toward that quote unquote contract business because it's electronic, where some of the spot business is driven off of things like load boards where it's confirmation sheets. But if you look at the general market conditions as it relates to volume, you do see, and what was interesting is we actually saw, if you look at that May number, so the green line is 2018 and the blue line is 2019. And you can see an abnormal move in mid-May where we saw a drop in volumes, and that's atypical. One of the reasons that people have been asking when we do comparison about why are we driving that 2019 is softer when if you're just compared to 18, it's obviously going to be softer. But one of the things that I always argue, or I've argued, is that what we would normally see in a normal seasonal pattern is from April and early May, you would see a surge of activity happen at the end of May. We didn't see that. And one of the things that really caught us off guard is how drastic the drop it was. And no coincidence played into what was happening at the ports. But then we saw a rebound in volumes happen in the month of June. And so we've seen right after Memorial Day, which is that big drop that you see, the second big drop you see, is Memorial Day. We actually saw that the volumes sort of increased over May, and we saw a resumed pattern of increase, and then we saw it flatline. Now, one of the things that concerns me right now is if you look at the last couple of weeks, particularly the last week, we've seen volumes start to pair off. We're not seeing that end of the month, end of the quarter surge that you normally would see. And so that's something to watch, and it may suggest that our third quarter will actually be softer even than our most conservative estimates. Moving into talk about really the state of the freight market. And one of the things that I discussed on an interview with Emily was the fact that while overall GDP, imports-export activity is a smaller percent of the overall market, about a third of the freight market is impacted by imports or exports at some point. And so one of the things that's been driving the freight market is really directly related to what happens at the ports. You can look at that big green line, that's LA, and you can see the volume, the OTVI index, dropped off significantly right after that tariff went into effect. The new tariffs went into force, is that we saw a significant drop off and actually about a 20% drop off after implementation. If you go back and look at where volumes have been trending and you compare 2018's numbers from compare 2019's numbers versus 18, the LA market is still up tremendously. It's still up about 1/3. But put that in perspective, if you go back to April, it was up 70%. So we saw massive volumes in April. And then in June, we've still seen year-over-year increases, but not as significant as what we saw last year. And then, of course, we're looking at what happens the latter part of the year. I think a lot of it is going to depend on what happens with tariffs. I'm going to ask you, Ibrahim, right now, over under, do we get a trade deal or some stability in trade policy in this meeting?
You're going to get some direction from this meeting, but you're not going to get a deal.
No deal
this year. But I mean, you won't get a deal this meeting. I do expect a deal at some point this year, though.
Do you get a Donald Trump deal which just says it's done and then he walks away?
Well, yeah. I mean, I think it'll be like a lot of things where you find a way to kind of claim a victory, and then
it is what it is.
Yeah. I mean, next year is going to be an election year, and so you can't kind of have this continued overhang of a cloud of trade uncertainty slowing down the economy.
Yeah. So he could actually just declare victory, as he's been known to do at times, and
that's what he did with Mexico, right? But yeah, that's what I would expect. I don't expect a deal this weekend. I do expect some direction, and I expect something before the year's out.
Got it. If you look at major freight volumes in terms of major freight corridors, so we've seen a lot of activity happen at the ports. The center of the United States, the heartland, if you will, Atlanta, Chicago, and Harrisburg, Philadelphia, have actually seen falling of volumes. They average, if you combine them, about 10% of total U.S. freight volume, so they're very significant. Atlanta being the largest single city in the market other than the ports, LA and Long Beach. And it is actually down sequentially versus May volumes. And this is interesting, is that we saw a significant drop-off versus 2018. So you're seeing a lot of activity at the ports. We're seeing the heartland, if you will, that's showing significant structural slowdowns. And that's probably indication that some of the other sectors that are really domestic production are struggling.
Yeah. I mean, I would say that. I think a lot of the weakness that you just have in domestic manufacturing is probably spilling over into these numbers.
So looking at spot rates, you can see that if we look at where spot rates are, that blue chart is really related to the long haul market. And so one of the things that we've reclarified is our definition of the actual rate indexes. It's a really long haul. We've been talking about DAT rates and really been referring to the long haul markets. We've actually reclassified those because there were specific lanes that were really predicated to those longer length of hauls. And what we've seen is that the freight rates, the spot rates, are actually back to where they were in 2017. On the surface, that looks positive, but that doesn't tell the whole story about why we also assess that as not a strong number. And it's because costs have gone up significantly for carriers in that period of time. And so you've seen cost increase. We've seen things like maintenance expenses up 13% in that period of time. We've seen earnings and total wages across the whole sector up by 6%. And actually, over-the-road truck drivers are up double digits, sometimes 18 to 20% for some carriers in that period of time. So you're seeing significant headwinds as it relates to expenses for pay, for maintenance, and then, of course, diesel prices. Diesel prices are up 20% in that period of time. So we have significant amount of cost increase at a time when rates are basically flat from where they were in 2017. And so just significant headwinds. The other thing that, of course, is a favorite of economists is the Fed funds rate. And so one of the things to keep in mind is that nearly every trucking company has some form of debt financing, whether it's equipment or physical plants or warehouses or whatever. They are capitalizing that equipment and they are borrowing money. And so this actually has a significant headwind on them, going from less than 1% in June of 2017 to 2.39%. And so while it's good for savings, if you run a trucking company, chances are you're not putting cash on the balance sheet. You're buying equipment.
But a rate cut coming at the end of the year.
So there is some headwinds that takes it away. One of the things to keep in mind is a term that's a favorite of the trucking industry is operating ratio. And so operating ratio, for those that aren't familiar with it, is basically the net inverse of profitability or operating profitability. And a high operating ratio is a bad thing for an operator. A low operating ratio is a good thing. And what we're seeing is that operating ratios, as we look in 2017, we basically have gone back to except for the refrigerated market. We're back to where we were in 2017 in terms of operating ratios. And so since you look at that huge dip in 2018, carriers were doing quite well back then. And that was really related to just high volumes and high pricing. And now we're fast forward into the month of May, the last paint that we have on this particular index. And we're seeing that for the broader markets, we're talking 96 to 98 OR, which is not great. And so if you take that Fed's funds rate, add it on top of your OR minus Fed funds rate, you actually look at what it costs for capital. Yeah. You're basically teetering on breaking even. So it's certainly something to watch as we move into it. Another thing that we watch here is the tender rejection data. Tender rejection data is just a function of, are carriers willing to accept the loads that are being offered to them? Do they have optionality? A lot of it's related to the lanes and rates and the combination thereof. And we're seeing that earlier this year that tender rejections actually hit. We've been tracking this stuff for about 18 months. Tender rejections were at an all-time low of that index, around 4%. And they have since in the month of June gone up. That's an indication of higher demand. It's an indication of better price freight. We're back to where we were in the month of April, but we're not back to where we were at the start of the year.
Now, do you think some of this is also seasonal kind of?
Absolutely. I wouldn't draw. I think what it suggests is that carriers have the chance to be a bit more selective. Mm-hmm. But I wouldn't draw any long-term trends in this. In fact, when you're only at 5.72%, I mean, we saw last year, and I wish we had the chart on here, but we saw last year that tender rejections at some part of the year were at 30%. Mm-hmm. And so we're not seeing any significant pressure, I would call significant pressure, over 10, 15%. We're not seeing any of that right now. And so, I mean, last year, if it ever dipped below, I think that it stayed above 18% for most of the year when we first started doing this. It was only earlier this year when we saw that sort of break, and since then we've seen deceleration. What's good about that is since the road check conditions, since road check sort of kept capacity in check, that tender rejection has stayed higher since then. So we haven't seen it fall back. But again, I think your point is spot on, is that a lot of that is related to just seasonality. Moving into national tender rejections, if you look specifically at mode by mode, you can actually see that the overall van tender rejections did increase as reefer did, but refrigerated tender rejections are up to 16%. Now, keep in mind, the refrigerated guys tend to operate a bit more in the spot market. There's a lot more seasonality to their business than there is for the broader market. But we're seeing some encouraging signs for the refrigerated market. The challenge for those guys is that they have a really great, huge season in the summer for produce, and then they don't have the same kind of conditions in the fourth quarter. So we'll see how that factors up. But a delayed harvest from the rains, the weather has been the story of the refrigerated market. And then we had a little bit of trade fluctuations, which might have impacted some of that as well as people move product in there. Agriculture spot rates, again, just talking about what's happening around produce, is that it's in full swing right now as rates climb and continue to climb. The question is the weather, and we don't have Nick with us, but I think what happens with the weather and how does that impact the rest of the year?
Well, I mean, it's been a big story during the first part of the year anyway, that in the beginning it was kind of like weather was delaying some of the produce from being planted. But now I think some of the things I've been reading has just been saying it's just been canceled for a lot of farmers. Like now it's too late.
Yeah, you can't get that back.
Exactly.
That is literally the one commodity that is perishable. I mean, by definition.
Exactly.
Even the harvest season is perishable.
Yeah, so. But we basically have had flooding somewhere in the economy since March through April through May. There's been different areas of flooding throughout.
So unfortunate for the farmers who have been, and then also just add the tariff impact. So from the agricultural community is impacted by, uncooperative weather, I should say, and then also uncooperative tariff conditions that have really impacted the agricultural community. Looking at truck orders are a good sign of sort of forward sentiment on capacity and forward development capacity. We're seeing new truck orders fall back. They're down 70% versus from 19 to 18. And then new orders were the lowest in 5 years. So now that's an indication really that people just aren't buying as many trucks as what they were before.
Yeah, I mean, one of the interesting things I saw was that the number of cancellations actually kind of surprised on the downside. Like normally when you have orders fall off like that, you find people that are also trying to rush to cancel the orders that they had already put in because there's a long production cycle. And they have cancellations have kind of ticked up a little bit, but they're not as severe as what I think I would have thought going into it.
I've talked to some of the folks that are buying equipment and some of the OEMs as well, and some of the feedback that they're getting is that a lot of those pre-orders were larger carriers that were just they had the trucks are more efficient. They have less maintenance issues than they did before. They're more fuel efficient, and because of the tightness of drivers are demanding nicer equipment. And so some of that is related to that. Again, as we talk about whether we're a bull or bear, some of the larger carriers are doing better as a whole than the smaller market, particularly ones exposed to dedicated and private fleets have not seen sort of the significant pressures. And so because of that, there's still a demand. Like you said, these orders are outstanding. I think with labor shortages continuing to be an issue, then the private sector will probably be relatively strong. One of the other places that we actually look at data is related to intermodal and comparing intermodal to truck. That purple line is the spot rates from LA to Dallas for truck. The blue line is the intermodal spot rates from LA to Dallas. What's interesting about this data is that truck has seen a recent uptick on that lane, whereas intermodal has not. And so what we think's actually happened on the volume side for intermodal is that shippers and brokers were actually moving and shifting demand to the truck side of the house as spot rates were low, and as we have seen spot rates tick up in the month of June, that there might be a reaction in the intermodal rate, but we're not seeing that just yet. So right now, it is more expensive today. It wasn't a few weeks ago, but it is more expensive today to move a load from LA to Dallas on an intermodal container door to door than what it is on a truck. And we'll see. We haven't seen that increase happen. The other thing to watch is trucking company failures. Trucking company failures are a sign of capacity leaving the market. And I think we're seeing two things happen from capacity leaving the market is fleets are not growing as fast or growing at all. Some of them are shedding the total amount of trucks that they have on their rosters. We get that information from the insurance companies when they're doing the insurance renewals. They're actually saying, I don't have an index to support this, but talking to some insurance brokers, is they're saying, some of the carriers had 10 trucks last year, showing up with 6 trucks this year. So they're shedding some of the equipment that they had. They're not seeing them renew as many trucks on their rosters. Bankruptcies are also a thing to watch. We have seen an uptick in bankruptcies. Go back to really where we were in 17. You saw that dip in 18 related to just good conditions. And we're back to sort of resuming. I think the thing to watch is, do we see a 2014, 2013 level bankruptcies? That is something that's going to indicate sort of the sentiment of the market. I think if the broader economy stays strong and retail stays strong, we may not see significant downward pressure. Looking at air freight rates, I like to look at the air freight market because it's an indication of on-demand expedite. When supply chains are tight, you see air freight demand is higher, and that we've seen air freight rates actually drop, particularly on that Europe to North America lane, which was stronger last year, even in light of tariff activity, and we're seeing that soften. And now the Asian Hong Kong to North America rates are also dropping. So watching air freight activity and seeing what it suggests in terms of on-demand expedite, and that's an indication of really strength. And so it's something to watch. There are certain sectors that are always more predisposed to air freight, but you also see when the broader economy happens, JIT supply chains demand faster air freight time. And we've seen throughout 19 some softening of that, and something to watch. Moving forward into containers, I think what's happening in containers is really twofold, is that some of the ocean lines are starting to pull some of the boats off. They're as they look at IMO 2020, they're actually reducing capacity. And so we're going to see some increases related to just the fact that capacity is being reduced ahead of that new regulation. Some of the older boats are being moved out of service or pushed into different lanes. And then there's also the chance of a pull forward. If we don't have good resolution in tariffs, as there doesn't seem to be good sentiment, we might see some of the retail shippers, the folks moving retail goods, actually advance product in for anticipation of peak around for that retail peak. And so we might see some pressure earlier this year than we would normally see. And so it's something to watch. Just looking at the flow of freight, this has been discussed throughout a lot of different commentary, is just how supply chains are shifting. Vietnam is the big victor. Vietnam is actually up tremendously in terms of the volume of imports. It's shifting how carriers are doing it. Now, some of that is just relabeling. And so what they're doing is they're taking goods from China, relabeling it as made in Vietnam and shipping it out. But I do think there's some organic factory movement. It's hard
Probably
to
a mix
know.
of both, I would say.
Hard to know, but China has been certainly the big loser related to freight volume, with Vietnam being the big victor and other countries as well. Just a summary of the market is that we've seen the freight economy struggle in the first quarter. And then I think the question of renewed concerns over trade policy will threaten the growth, if there is any growth this year.
Yeah.
Truck employment stalled, as Ibrahiim talked about, but the industry still is oversupplied. Spot rates are falling, have fallen. And I think contract rates may continue to fall even if we see volume growth improve. And I think what's going to happen is those quote unquote contract rates, those committed rates, are going to show downward pressure at a time when spot action may be going up. So let me say, I think the part that's probably going to be most pressured is those brokerage margins, where they have rates locked in and may have to pay higher than market spot rates. And I think just the summary of the market is that the freight market was oversupplied. No shock there. If you've listened to any of our commentary, or frankly anyone's commentary, you would see that. And the market is starting to correct. That's slightly shown up in bankruptcy data. It's also showing up in those new truck orders. It's showing up in employment stalling. So we're seeing the market starting to correct. I think if we have sort of a stall, that might be a really bullish sign for some of the carriers in 2020, if the economy doesn't go into a broader recession.
Well, yeah, I mean, I actually gave a talk a couple days ago, and I basically said that, like, when you're in this kind of environment, I mean, what happens when rates surge the way that they do is you get everybody anybody that can join into freight does, and they're not always the most efficient people that are kind of coming in there. People aren't
Anybody could make money last year.
Exactly, and when rates come back down, the people that get washed out are going to be the ones that are inefficient. And so, there's just a sort of, the industry's kind of trying to find an equilibrium, and it's going to be like the really inefficient ones are going to be the ones that get forced out, kind of get washed out of the industry.
Now, one of the things we didn't talk about, but I'm hearing, is that there's a flight to quality for drivers.
Mm-hmm.
So what's happening now is that the trucking companies that can keep the drivers running are finding that it's easier to get drivers, and the carriers that aren't able to keep, the ones that were in the spot market couldn't keep them running, are struggling to hire the drivers. So in some ways, we're seeing this sort of bipolar market happen right now.
All right. Thanks so much to Craig and Ibrahiim for sharing your insights. If you're listening in and haven't already, please go ahead and submit your questions for them. We do have a few so far, so we'll go ahead and dive right into those. First question: if I follow the trend line, you have a record low unemployment in the U.S., but depressed goods demand. Where's the surplus spending disposable income going in the economy?
I mean, you can take that, but it's services, right? It's more expensive. Housing's more expensive.
Right, exactly. Like, if you look at just overall consumer spending, it slowed a little bit in the first quarter, but it wasn't nearly as poor as, say, just like the good side of the equation. Like, retail spending was basically flat during the first quarter, but spending overall did okay. And you're right. Like, a lot of times the spending just goes to different services, banking,
and millennials, or just general younger people are taking more trips and travel.
Mm-hmm.
Healthcare is a higher portion of your disposable income. Sure. To health expenses.
Yep.
Housing is a bigger factor. So
yeah, and so I would just say, like, they're still spending their money. They're just not buying. At least they weren't buying retail stuff during the first quarter. The second quarter numbers have been better on the retail side of things. like I said, retail's kind of stabilized in the second quarter.
Cool. Great. And next question. Can you please give us some color on some of the LTL carriers that have closed, as well as some of the ones you feel have a very large headwind for the rest of 2019?
Well, I think specific to LTL carriers, and I think the only major one that I know that is closed is New England Motor Freight. That's the Northeastern carrier. That appears, from what we've been able to discern, is that particular carrier had really two things really cost it. Well, I would say three things. One is it's geographically in the Northeast, which is a difficult market overall. It was a union-based carrier, which meant that their labor contracts were not malleable as the market changes and demand changes, the customer changes. They couldn't change the nature of how they operated their business. Their networks were not adaptable to those changes. And I think, lastly, the union, because of its lack of flexibility in its contracts, would not allow them to respond to market conditions. Amazon is really the story there. When Amazon changed its network in the first quarter, it appears that New England Motor Freight could not really respond efficiently to those changes. So I think in this environment where companies like Amazon or those on-demand expedite and fluid networks are more important and flexibility becomes very important, then it's difficult if you have really anything that is inflexible. So if you have an inefficient labor structure, which unionized carriers do, or an inefficient capital structure, which companies that are heavily debt-ridden aren't able to make those investments, then it becomes pretty difficult. So I would say that any of the large union carriers are probably more prone to, if you were to say, if we had a real sort of downward cycle in the broader economy, they would be the ones that are most exposed. I think the exception to that is UPS, because UPS at the end of the day, and Ibrahiim may or may not speak to this, is in many ways insulated from some of the broader labor issues because of the strength of parcel.
All right, next question. LA is such a key market for imports. What do you see for trends for other ports building up for capacity and where the market could be headed, specifically in reference to Jacksonville, Houston, Savannah, Charleston, Seattle, et cetera?
It's interesting because I got into a dialogue with someone on one of the social media networks about strength in Charleston, and the discussion was, well, at the end of the day, it doesn't matter, because when you take Charleston as a percent of the overall ground freight, it's like 15 basis points, 0.15% of all freight out of all U.S. truckload freight, 0.15% originates in Charleston. So at the end of the day, Charleston could be up 100% or 100 times, and it wouldn't matter at the end of the day. And so I think really the state of the freight market, particularly that long haul market, that's more predisposed to that over the road for higher demand, is really, really a big port issue and more predisposed to the West Coast. And so as it relates to the other ports, Houston and New Orleans and places like that tend to have more industrial chemicals and petro impacted by the petroleum markets. And so as long as U.S. demand, as long as petro and oil prices stay relatively high, there'll be a lot of volume coming out of those ports. The East Coast ports, particularly New York, New Jersey, and maybe Roanoke's in that picture, it tends to be a bit more retail of a game, right?
Yep.
So.
All right.
Jacksonville is an auto. I mean, Jacksonville is almost a lot of what comes in and out of Jacksonville is auto-based.
Great. Next question. A few months back, you guys were less concerned about tariffs and their potential impact on GDP in the freight markets. It seems to be more of a concern today with demand, psychology, and the supply chain in general. Do you still expect this to have minimal impact on overall growth, consumption, and production?
Well, this is where an economist and a freight guy will slightly differ and disagree. I'll talk first of all on the freight standpoint. It's about a third of freight volume is predicated on what imports and exports. And the thing to keep in mind is it's not as much about price in the overall GDP as it is about disruptions in supply chains. And so what we're seeing play out with tariffs is that companies are changing their supply chains, are disrupting their supply chains, or holding off capital investments because they don't know what the certainty in their overall supply chains are. So as they start to move freight to Vietnam, it it basically creates pressure and detracts them from making other types of investments, which then holds off freight demand coming to the markets. It also shifts, if you move your freight demand from, say, China to somewhere where maybe you're getting freight from to the East Coast faster because you shift it to a different country, then in those cases, it will shift where the demand shows up.
Yeah, I mean, I generally agree with that. Like when you look at sort of what the impact has on the overall economy, number one, trade is, it's a fairly small part of the overall economy. Like when you look at like exports and imports, they're about 10 to 15% of overall economic activity. So when you shock it with tariffs, it causes a disruption on that side, but that's not enough to derail the economy one way or another. And the other thing is that like a lot of times with tariffs, you find companies that'll they might import less, but that gets replaced by domestic production here. So that blunts the effect of tariffs as well. So the overall economic impact is still only like a couple tenths directly. What I've always said is that you really worry about like these sort of secondary effects, these spillover effects that come from tariffs. Like it's not the fact that imports and exports become more expensive. It's the fact that businesses no longer want to make investments because they don't understand what the trade environment's going to be. And that goes back to like what I was talking about when we went over factory orders and manufacturing factory orders, and you see the stalling out in business demand. That's like a secondary effect that comes from tariffs. And I think that is an important kind of impact, is to take, an area of the economy that was growing pretty quickly. And because you just don't know what the tariff environment is, you get sort of a stalling. I actually think it's more damaging that we don't know what the trade picture is going to be, that there are higher tariffs. Like I think the economy would be better if we would just raise the tariffs already and be done with it. Than to just kind of
it just seems to be a whim of one person decides.
Well, right. And if you're a business in this kind of environment, how do you operate? Like, how do you know where
you're one tweet away from another tariff impact? So
exactly. So I do think those kind of secondary effects are important from a growth perspective.
Great. All right. I think we've got time for one more here. There are reports that millennials are starting to settle down. They'll buy homes and then buy more goods to furnish their homes. An additional reports that spending power of the next generation is larger or as large as the millennial generation, and thus we should see continued increase in the supply-demand curve for the industry. What are your thoughts?
Yeah, it's interesting. If you listen to some demographers, which I've had the opportunity to go listen to, is that a lot of the economic cycles are actually predicated on how many people, just population. And so we do see that I think it was Gen X had the lowest amount of population, and we saw an increase in millennial population. So certainly as millennials move out of their parents' house or out of apartments into bigger homes, then they're going to buy stuff. I think the challenge is really, what are they buying and what are they consuming and how are they consuming it? So one of the things that I watch is actually autos, is that there is a trend happening with younger people to not buy cars. And there's a theory, there's some different points of view, is that, in the next couple of years, we may see where people just aren't buying cars because they're able to get the on-demand services, or they're able to perhaps, the Netflix model of renting it on a per month basis and not actually having to own it. And that may change the cycle of how people are buying products and consuming things. And I think certainly those on-demand services are certainly having an impact. Ibrahim, do you have anything to add to that?
Yeah, I mean, I hear a lot of people say things like millennials don't like to do this and millennials don't like to do that. There is some of that, and I think autos are probably a pretty good example of that. But I think a lot of that talk is overblown. Like when people say like millennials don't buy houses as much as the previous generation did. I mean, when you really dig into it, a lot of it is because they just don't have the financial capabilities to do it yet. They're delaying marriages, later than their parents did because they can't afford to get married. They're delaying home purchases because they can't afford to buy homes, and a lot of that ties to things like student loan debt and sort of the burden that they have there. But to generally address the question, like I do think that there is going to be sort of an increase in home buying going forward as millennials get older. They haven't had like the normal surge that you would typically find around, say, age 27 to 30, but it'll still happen. They just have to.
It also depends on where they live, because if you think about where millennials are attracted to are bigger cities, and so they're not buying the McMansions that you saw with my generation. They're not buying the biggest homes in the market.
Great. All right, guys. Well, that is all of the time that we have today. Thank you so much to Craig and Ibrahiim for being here and sharing your insights. And thank you to all of you for listening in and engaging with your questions. We certainly appreciate you being here. If you have not already signed up, we are gearing up for our FreightWaves Live event in Chicago, November 12th and 13th. If you'd like to learn more or purchase tickets, you can visit www.freightwaveslive.com. Thanks so much again for being here, and we hope you'll join us again next month.